I'm Jim Pierce with Baton Investing. Every day, people like you come to us whenever they realize their current investment approach just isn't working. We give them an easy-to-use system that has beaten the S&P 500 by more than 300% since 2003, takes just 30 seconds a month to use, and most importantly will help you achieve your financial dreams. Now today's free stock tip is a company called HCI Group, which is primarily in the business of selling property and casualty insurance in the state of Florida. Now I know that may not sound terribly exciting, but it is a very profitable business. So much so that it earns a perfect score of 100% from our investment strategy based on the fast grower methodology of Peter Lynch, who managed the Fidelity Magellan Fund to an amazing average annual return of 29% from 1977 until his retirement in 1990. Now the reason why Lynch was able to accumulate such an incredible track record is that he specifically looked for companies that are able to grow their earnings at a higher rate than the stock market values them, which is often referred to as the PEG ratio. So let me show you how that works. So again, the company that we're talking about is HCI Group, symbol is HCI, and it's currently trading at about $47 a share. PEG ratio stands for price to earnings to growth ratio, and what Lynch does is he takes the current PE ratio, which for HCI is 8.57, and then he divides it into the average annual growth rate of earnings over the last 5 years, which in the case of HCI has been growing its earnings at an amazing rate of a little over 49%. So if you divide that PE into the growth rate, you come up with a PEG ratio of 0.17, which is well below Lynch's upper limit of 1.0. But he also wanted to make sure that the company was growing its earnings at a sustainable rate. So he wanted to see that earnings growth rate of no less than 20% a year, but no more than 50. And in the case of HCI, that growth rate of 49 just comes in right under that upper limit of 50%. In addition to that, he also wanted to see an equity to assets ratio of at least 5%. And again, in this case, HCI easily beats that with a 30% equity to assets ratio. So in other words, here's a company that's growing its earnings at a very high rate, and yet the stock market's valuing it at a multiple at about half the overall market. In addition to that, if you buy HCI now, you'll get a dividend yield of about 2.6%, which is about the same as the 30-year Treasury bond is yielding. So currently priced at 47, we think it's a buy up to 50, and again you get that nice dividend yield of 2.6%. Now, HCI is just one of 10 stocks in the current Baton portfolio. Every month we identify the 10 highest scoring stocks out of the more than 6,000 that we evaluate and rebalance our portfolio accordingly. If you want to know more about how the Baton system works, just visit batoninvesting.com and click on how it works. There's also a simple 3-question assessment to help you determine if Baton is right for you. And we can only help about half the people that come to us, but maybe you're one of them. So go to batoninvesting.com now, and I'll see you again soon with another free stock tip. Thank you.